Good afternoon, everyone. Welcome to Westwood's fourth quarter U.S. value update. Today, our U.S. value team is going to review the fourth quarter from a macro perspective and provide a little insight on what's driving markets and share their economic outlook on what's influencing the team's stock selection. After that, we'll shine a spotlight on the consumer sector, where we'll focus our attention on holiday spending, how inflation continues to impact consumers, and what we're looking for in consumer stocks in 2024. I'm Peter McCarthy, Senior Vice President of Institutional here at Westwood. I'm joined today by Matt Lockridge, Head of the U.S. Value Team, Portfolio Manager on our large and small cap strategies. In addition to his PM duties, Matt covers research for the consumer staples and consumer discretionary sectors. We're also joined by Lauren Hill, who is a portfolio manager on our large cap, all cap, and mid cap strategies. As an analyst, Lauren is responsible for coverage of consumer retail stocks, business services, and consumer finance names. I'm excited to have both of them here today, and we look forward to sharing our perspective with all of you. For today's presentation, Matt's going to provide an overview of the economy and the stock market, as well as share our perspective on what's driving returns in the marketplace. He's going to provide some new insight on how the U.S. Value Team looks at the broader economy and how their assumptions provide a framework for the research process. After that, we'll turn to Lauren, who focuses on consumer retail and consumer finance companies within her coverage. Lauren's coverage gives her a unique lens into consumer spending patterns and how they ultimately factor into our stock selection process. With consumer spending driving as much as 2/3 of GDP, it's an important part of the economy, and we're grateful to have someone with Lauren's experience and insight on the team. While we're here, I just want to give you a quick refresher on what we do at Westwood. Our U.S. Value Team seeks to identify companies at the intersection of quality and value. With our fundamental analysis as a key partner of our investment process. For more than 4 decades, we have focused on value investing, managing portfolios across the capitalization spectrum. Our team of 11 investment professionals are research analysts first, as well as portfolio managers, organized by industry rather than market capitalization. Our approach to value is to find companies at the intersection of quality and value, companies that are undervalued and mispriced, quality businesses with the potential for attractive future returns. So just as a quick reminder, this webinar is being recorded, and we'll send a link along with the video and along with these slides by email to all who have registered for this call. We will also leave some time at the end for questions, so please use the Q&A box at the bottom of your screen. We will do our best to get to everyone's questions. And now, I will turn the call over to Matt for the fourth quarter review.
Okay, thanks, Pete, and thanks everyone for joining us today. So I'll start with a very quick review of returns for the quarter, and then we'll dive into some market insights that we think are particularly important. So it was obviously a strong fourth quarter for equities as the market sensed that we were nearing the end of the Federal Reserve tightening campaign. And we'll talk more about that in a moment. But in the end, really a barbell approach is what we saw for the quarter, where we had large cap growth as well as small cap value leading in the period. From a sector standpoint, really the only call out that we would make is the energy sector. It was down about 7% on a roughly 20% decline in oil prices. And for the year, all market cap ranges were positive. Growth really led meaningfully up and down the market cap spectrum, which was a reversal from what we saw the prior year, when growth and specifically technology took it on the chin in 2022. So a nice reversal that we saw. On the next slide, we really start diving into performance during the period, and it was somewhat of an unexpected year from our standpoint. As fundamental investors, we talk to businesses every day, and one of the things we heard a lot last year was the increase in costs that businesses were seeing, input costs, labor costs. And so in that type of environment, you would expect those businesses with the highest margin to be able to outperform and weather that storm. But actually last year, we saw businesses with the lowest margin actually do the best. Also, in a year where we saw higher interest rates and a pressure on the cost of capital, you wouldn't expect those businesses with the highest debt loads to do the best, but that's actually what we saw. High debt companies outperformed low debt companies. And then the most volatile businesses actually were the best performers. You can see here the highest beta companies in the S&P did the most. On the next slide, we get into why we think we saw some of that. So this is performance through 2023. We've pulled out two baskets of securities. The first is the highest return on invested capital businesses, and the second is the highest beta businesses, or the most volatile. And what we saw after the Powell pivot, as we're calling it, where the market began to sense that, okay, we're done with interest rate increases, you saw the highest beta, the most volatile businesses start to outperform, and that's really what drove performance, as we saw in the prior slide, for the year. On the next slide, we do want to point out that we've seen this type of market behavior before. This is the last time the Federal Reserve pivoted from interest rate increases in 2018. And this is a similar highest beta basket of securities. And you can see once we get past the last hike, you'll see a very sharp but short period of outperformance by the highest beta companies. And so we think we're going to see a similar type performance this time around, where as fundamentals start to move to the forefront, the most volatile businesses will begin to underperform again after this sharp period of outperformance. On the next slide, just kind of taking that one step further and looking at valuation of these businesses. This is the PE of high beta companies within the S&P versus low beta. And you can see over the last 10 years, we're now at the upper end of the range, where high beta securities are being priced the same as low beta, more stable, more visible earnings growth companies, which we don't think is a long-term phenomenon. On slide 10, one reason to also view this group with caution is, from our standpoint, there's very little risk right now being embedded in the markets. You can see here in the top left, we have the VIX near lows, and the bottom left, credit spreads also near lows. And the S&P 500, as you see in the bottom right, expanded its multiple by 4 points last year. So, putting all this together, we think it warrants some caution as we approach the markets and the types of businesses to invest in going forward. On the next slide, the recent market exuberance has been, as we talked about earlier, largely driven by the view that we're near the end of interest rate hikes and we're getting closer to interest rate cuts. But the bar is set pretty high. You can see the number of Fed cuts that are expected as of the end of the year. So 150 basis points in cuts this year is a tall order if inflation proves to be more sticky than many expect. So flipping to the next slide, we have our economic framework. So this is a framework that we put together each quarter that we use as fundamental analysts to make sure we're on the same economic viewpoint as we look ahead. So this is really our operative scenario as we look out the next couple of years. Each quadrant represents one of our research groups that we use here in US Value. Again, for those less familiar, these are groups of our analysts that cover similar industries. So they're very knowledgeable on what is impacting those industries. We come together as an entire team to vet and really put out our forecasts for the year ahead. And so these are some of the variables we're finding most important today. At a high level, we expect economic growth to decelerate as we move through 2024. And that's really from the lagged effect of the monetary tightening that we've seen over the last year. We think we're going to see unemployment begin to tick higher. We're seeing some of the leading indicators of employment deteriorate, things like temporary employment, labor supply, quits rates, et cetera. And so that's leading us to expect that the headline unemployment rate should move higher. We also realize that fiscal spending has been a major driver over the last few years. And that is really a partial offset to any weakness in some of the economic fundamentals on the demand side. That's particularly the case in some of the industrial areas. And just lastly, we're watching for signs of inflection for an improvement in corporate profit growth. One of the indicators that's really the best in leading corporate profits is the ISM Purchasing Managers Index. So we're watching that for an inflection that gives us a signal that actually corporate profit growth should start to accelerate as we move through 2024. So watching that closely. So with that, I'm going to turn it to my colleague Lauren Hill to give you all some insight on how we're viewing the consumer.
Thank you, Matt. So after a soft October, we were pleased to see retail sales pick up for the holiday period. They were stronger than expected, growing 4.8% year on year. And so as consumers remain under pressure, we have higher housing prices, higher debt levels, higher rates on the debt that's outstanding. And we also saw the repayment of student loans begin again. Despite all those headwinds, consumers remained employed and confident in their spending. And so that helped us finish the year and go into 2024 on really solid footing for the economy. And that was boosted by online sales growth. So it's a secular trend that we've seen for a number of years, is consumers continue to visit stores in the mall less frequently. When they do go to the mall, they're visiting fewer stores per visit and spending less time in each store, and they're continuing to spend more online. So those online sales more than offset the decline that we saw in stores. On the next slide, you can see inflation. So though inflation trended down all of last year, it still remains at an elevated level. And the chart on the right, you can see what that means for consumers is the average price of goods and services is 15 to 20% above what it was at the end of 2019. So that makes for a very price conscious consumer. So the other factor that really took place this past year is with all the stimulus checks, consumers had a lot of excess savings coming out of the pandemic, and they really spent those down and they turned back to debt. So we saw most of the credit card companies reported mid-teens growth in balances this past year. Buy now, pay later, especially used by younger folks, really continued to grow at an extraordinary pace. As consumers look to make up for that additional 15 to 20% price by using debt to continue to buy the items that they usually do. And so consumers continued to really seek deals and reduce the frequency of their shopping trips, and even went without certain items. And so we continue to see, even with inflation cooling, higher prices continue to influence consumer behavior. And on the next slide, looking out, so as long as inflation stays low, the Fed is going to remain supportive. So especially if we start to see the unemployment rate tick up, we could see the Fed supporting the economy through rate cuts. That would be a very big positive for housing activity, also big ticket purchases, think autos as well as large appliances. We could start to see more purchases there again. And then with lower rates, we could also see more CapEx investment. And one area we are particularly excited about as a team is looking at technology. We've seen a lot of new AI investment, and looking out over the next 3 years, Westwood's typical investment timeframe, we can see a lot of the investments today becoming exciting new innovations that lead to greater demand for PCs, smartphones, and tablets that have all new capabilities. So as rates fall, we're also going to you can see in that chart, we'll start to see housing rebound and, just consumer activity pick up. And with that, I'll turn it back over to Peter to lead our Q&A.
Great. Thanks, Lauren. Appreciate that. And now let's open the floor to questions. As a reminder, please use the Q&A button at the bottom of the screen to type in any questions. We'll see them fairly quickly and be able to answer them properly. Okay. Lauren, here comes a question for you coming in. It says, one of the things you mentioned is strong online sales for the holiday season, which continues to be a trend that's happened over the past several years. Outside of Amazon, which obviously no doubt is a big winner of all these, are there any other companies that you've seen that likely made a strong mark on online retail?
Yes, another large winner that we're actually invested in is Walmart. They have the Walmart Plus program, and so we've seen tremendous growth there. I think the outlook this year is for 32 to 50 billion incremental dollars to get spent. So, Walmart has a lot going for it, but being able to make purchases online and have delivery, and then also be very price conscious and find the lowest price, which Walmart offers, is really attractive to consumers today. So, we see a lot of big things in Walmart's future, and they continue to compete very well with Amazon.
Perfect. Thanks, Lauren. I think here's one that came in, probably a better fit for Matt. And it says, it seems that market expectations are moving both ways lately. In November, the market thought the Fed would be cutting in early 2024. And until recently, it seems that the first rate cut has been pushed back to the second half of 2024 or later. How do you manage the portfolio when the macro expectations seem to be all over the map?
Sure. No, that's a good question. Well, I would start by saying at the outset that we are fundamental bottom-up investors. And so we're trying to buy businesses that we feel have very limited downside and upside that is materially greater. So we're trying to find asymmetric reward to risk. And we do this in the higher quality end of the spectrum. So we're only investing in businesses that generate free cash flow, that have high returns, that have conservative balance sheets. And so we feel like we're starting from a good spot. We're in businesses that are able to control their destiny. They have competitive advantages more than the average company. We're buying those businesses when we feel like there's limited downside. The way we layer in our macro views is really with the U.S. Value Economic Framework. We want to ensure that all 11 of us within U.S. Value are using the same macroeconomic assumptions in our underlying fundamental models. So we want to make sure that we're all using the same interest rates, for example, in our DCFs. We want to make sure that as analysts looking in commodity areas, we're using the same assumptions for forward curves of commodities. That way we can compare ideas across analysts. And so if we're all operating under the same general economic assumption, it allows us to compare apples to apples at the portfolio level. And that's really how we build portfolios. It's finding the most attractive individual securities with the best reward to risk at any given time, knowing that we're always using the same underlying economic assumptions.
That's great. Here's another one for you, Matt. It says, your expectation is ultimately that the economy slows in the second half of 2024 and even more of a slowdown in 2025. Are there any particular sectors that you're looking at today that look particularly promising in the event of an economic slowdown, or even if we end up in a recession?
One area that's looking particularly attractive from a reward to risk standpoint is the consumer staples area. This is a sector that lagged last year, which is not unusual as interest rates move higher. Some of the areas that are considered more bond proxies, like staples, like utilities, often lag in those environments. There was also some expectations that these businesses wouldn't be able to show the same type of top line growth as inflation comes down, because a lot of their pricing has been inflation based. And so as we stand here today, the reward to risk on the sector looks very good, and it's one of the more defensive areas. So should we get into more difficult economic times, I expect this area, household products, food companies, to do very well, especially relative to the overall market.
Great, thanks, Matt. There's one last question that it's actually geared towards Lauren. It just came out. Lauren, it seems that your outlook for consumer spending and consumer stocks is cautious. While consumers are spending, it seems headwinds like persistent inflation may cause slowdowns ahead. Are there any stocks that you'd like to mention that you're particularly enthusiastic about right now, and why? And let's make sure we cover both ends of the spectrum. Are there anything that didn't work in 2023 that you'd like to mention?
Yes. So, yeah, there's many stocks that that I'm very happy that we're invested in, but two that I'll highlight quickly are Domino's Pizza. So, Domino's remains one of the cheapest ways to feed a family if you aren't cooking from home. And so they have a number of things that are happening in the business that we like, but that also ties in with that larger consumer picture of consumers being more price conscious. And then another one is O'Reilly Automotive, which we also own in the large cap portfolio, and we like that one a lot. The company continues to gain market share, but along the broader consumer theme, consumers are looking to save money, and so it's much better to repair your car that you already have than to go purchase a new one. And so we continue to see really strong business for O'Reilly. One stock that we sold this past year was Estee Lauder in 2023. We expected that the reopening in China would be very similar to other countries, and management guided that they had included a slower reopening in their guidance numbers, but that turned out to not be the case, and they cut their guidance, breaking the thesis. And we met as a team immediately the day of earnings and decided to move on from the stock. So that's just part of our process. Not every idea works out, but we know what we're looking for in advance and discuss it. So when we see a thesis playing out or one that's broken, we can make decisions accordingly as a team.
Perfect. Thanks, Lauren. At this time, there's no other questions, so we'll conclude this portion of our presentation. Thank you again, Matt and Lauren, for joining us and for the comments today. And thank everyone on the call for joining us today. Just one quick reminder that we will be sending a link to the recorded presentation and the slides out next week. So please be sure to keep a lookout for that. Also, be sure to take a few seconds to review the exciting disclosure on the slides that follows. We thank each of you for your time today, and we look forward to seeing you soon.